In this video, I'll reveal one of the most important aspects of successful trading. Get this right, and it can transform your trading game for good. Position sizing in trading is as much an art as it is a science. Please be sure to stay with us until the end of the video, because there you will learn the magic of reducing risk by using the correct sizing in your positions. Sure, different market conditions might require adjustments in position size. During highly volatile times, you might opt to decrease your position size to mitigate risk, while during more stable times, you might increase it to maximize potential rewards. It is indeed common sense. However, consistency in position size will help you to reduce risk and minimize the impact of losses. Provide stability to your portfolio, in other words, keep your investments steady, and measure performance over time more accurately. It's tempting to increase your position size after a win or decrease it dramatically after a loss. Many trading gurus will certainly recommend you to do just that, and some inexperienced traders will even do the opposite in an attempt to recover their losses faster. Typically, this ends up in disaster. The fact is that consistent position sizing ensures that you don't risk too much or too little, keeping emotions at bay and strategy at the forefront. Oops, I just gave you a great tip to improve your trading psychology. There are several strategies traders use to determine their position size. In our Technical Analysis Mastery course, we mention the two most common approaches, the fixed fractional and the Kelly criterion. Fixed fractional involves risking a fixed percentage of your capital on each trade. For example, if you have a capital of $10,000 and you are comfortable risking 2%, then your risk for any given trade is $200 and you adjust your position size accordingly. But risk management isn't just about protecting yourself from potential losses. It's also about leveraging potential gains to bolster your defenses against future market uncertainties. This brings us to the innovative concept of trading 3 contracts, or 3 lots if you're a forex trader, as a trade unit. At first glance, it may appear riskier than using a single contract or lot, but in reality, it's a clever strategic approach that can significantly reduce your overall risk. Let me give you an example so you can apply it right away. But first, if you're enjoying this video, don't forget to hit the like button and subscribe for more content like this. Imagine you're looking at the S&P 500 and you decide to buy a position when it is priced at 1,000 points using 3 contracts. You set a stop loss at 950, essentially risking 50 points per contract. Your target is open, but you see a potential for the market to travel all the way to, let's say, 1350. Now the magic begins when prices start moving in your direction and reach 1050 points. Why there? Because the market has given you the exact amount you were risking, in this example 50 points. At this point you do 3 things. This is something we cover in detail in our Technical Analysis Mastery course, where you get 114 videos in 5 modules that cover from trend lines, MACD, moving averages, the Elliott wave principle, and trading psychology. For more information on that, click the link below. So here are the 3 things, the 3 action steps you do once the market has rewarded you with the exact same number you risked. First, exit one contract, locking in a 50-point profit. Second, move your stop loss to a break-even point, in this case 1,000, on the second contract. And third, leave the protective stop at 950 on the third contract. This way, if the market retraces and hits the point of entry at 1,000 in this example, the second contract exits at a break-even point. So even in the worst case scenario where the market plummets to your initial stop loss of 950, your third contract loses 50 points. But remember, you have already made 50-point profit on your first contract. These cancel each other out, ensuring that your position is net neutral. You neither win nor lose in the position. It's what we call a scratch. Please keep in mind that the example of 50 points only was chosen for clarity. I'm not in any way suggesting you use a 50-point stop in the S&P Mini. The idea is that you can apply the same exact concept to a 5-point stop and 5-point first target. You can even apply 2 ticks instead of points. So if you're a scalper, you can apply the 3-contract strategy to a 5-tick stop and 5-tick target. The principle is exactly the same. At first, you may be afraid of trading in 3. It may appear riskier than using a single contract or lot. But after you do it a few times, you'll realize it's a lot easier. Not necessarily to increase your profits, but most definitely to significantly reduce your risk. If you like this video, you're going to love this one.